If you're self-employed like myself, or you make a bulk of your money from side hustles, then eventually you'll probably have to consider alternative or private lending. In other words,
the dark side.
Honestly, the media overplays it. They're actually not that bad. And at the end of the day, if you use it to your advantage, you could be a lot better off. Try $100,000 better off.
Hold up.
Firstly, why do people seek out alternative lending? Yes, it's a little bit more expensive. Well, big banks are rejecting more people than ever now, and there's a few reasons why. First reason, especially, this is if you're self-employed, you're probably gonna write off some business expenses, which then qualify you for lower mortgage. It's just how it works. Now, the double whammy is that a lot of conventional big banks, they don't really recognize that unconventional income or those things you make for your side hustle. Now, thirdly, as of November 2016, we've probably heard of the stress test that basically makes you prove that you have to make a little bit more money than ever to make up for a buffer room. So honestly, if you look at those three things, it looks like you're pretty doomed as someone who's self-employed. Well, not so fast. Right now in Canada, about 15% of mortgages are actually done with alternative and private lending. Now, before we get into some really awesome scenarios of where alternative and private lending could be very advantageous for you, let's first explain what a alternative, or sometimes called a B lender, is versus a private lender. So alternative lenders, compared to what are A lenders or prime lenders, the big banks usually, or of course the monoline, where they differ in a few ways and where they're advantageous is, number one, they will be more flexible in your debt to income ratios, generally speaking, right? Secondly, they will definitely be more flexible in recognizing more of your non-conventional income, which could be Airbnb, it could be tips, it could be things that are just not as trackable. And lastly, if your credit score is just below the 600 threshold, they will definitely be a bit more flexible there as well. Just to address how much more expensive these alternative lenders are, let's look at the math. So alternative lenders usually will charge in the high 3.9 to 6% interest, okay? Now with a prime lender, they can go as low as 2.5, give or take 0.3%, usually between 2.5 and 2.8. Now, what does that actually look like in hard dollar amount if you calculate it on a monthly basis for, let's say, a $500,000 mortgage? On a $500,000 mortgage, let's say there's 2.99 with a prime lender versus 3.99 with an alternative lender. Now, what amount are you saving per month if you were to go with a prime lender? Now, if you guessed E, trick question, you're actually closer if you chose E than if you chose C or D. It's only $260, B. So it's not a matter of life or death, and honestly, if you just budget yourself accordingly and you go out a few less times for dinner, you will be in the exact same position with alternative lender and just being a little more budget conscious. Now, don't freak out, but the alternative lenders also have to apply the stress test most of the time. However, they can extend your debt to income TDS ratios. Now, what does this mean? Well, basically, your debt to income cannot be more than 44%, usually with a prime lender. With an alternative lender, it can be usually 50%, 55%, I've even heard of 70%. So to put this into a numerical example, if you go with a prime lender, and let's say your monthly recurring debt and mortgage is $3,000, then you have to make at least $6,800 for it to still be around 44%. Now, if it was an alternative lender at, let's say, 50%, you can make $6,000. Now, if it was up to 55, 70%, you can make in the 5,000. So again, there's a bit less pressure and they're more flexible with the extended debt to income ratios. Another really important part about being more flexible with your income with alternative lenders is that they accept non-conventional or non-steady sources of income, such as you've got Airbnb income, you've got commission income, which is more and more of a thing nowadays in startups or of course professional services. There's just a lot more flexibility around these kinds of income. I've even heard that they've accepted tips. Now, banks are really strict. If it's not 100% consistent to the T every year, they don't want to touch it. Now, alternative lenders are a lot more flexible and really practical. And we all know that if you know what you're doing, these will be very consistent forms of income. So I really have to side of the alternative lenders in the way to look at things in a very practical way. Now, with private lenders, they can really range in the kind of people you deal with. Now, most private lenders that you'll see are going to be very legit corporations that do this for a living and obviously have a very specific niche. This can also range to what's the proverbial loan shark or someone who's very shady. Just use your best judgment, and you really should also look at private institutions if the B lenders aren't a fit for you. You might be going to a private lender because you still didn't make the cut for an alternative lender. This could be because your debt to income was still a little bit off, or you're still not in a great place with your credit score. That's okay. Again, private lenders, the legit ones, I mean, I see as low as 5.99% to just under 10%. And which is pretty legit, and it's not that much more. And actually what they do private lending is they don't let you really pay your principal. They know you want an exit plan. So they'll do interest only loans, and they can have open terms, which are you can get out of it whenever you want. You could be there for only a few months if that's what you need. Or they'll do yearly ones you can keep renewing, and usually up to 3 years. So yeah, I mean, they can be definitely an alternative to actually get into the market if you want to do that, or if you bought a pre-construction, you need the money. There are people that exist and are very good options. So consider that. But the big thing is consider an exit plan. So when you have your mortgage broker, like really whiteboard out at what point can I leave this to go and level up to an alternative lender or to an A lender. And also for you know, alternative lender, you still want to see when you can go to a prime lender. All very important things as you strategize what you're going to do with your mortgage financing. So you do have to consider there are of course other costs when you do alternative or private lending. So there's a lot of work that goes into this obviously, and there's a lot of magic they have to make happen. So there's going to be some minor fees whether you renew the loan, if it's a yearly thing. There'll be some legal fees you have to pay, small ones. And the biggest one is you pay 1% of the mortgage total, and that's typically going to be for both the actual lender and of course your broker. So just ask them what are the upfront fees, be really clear about asking those questions up front, and then you can make an informed decision on whether it makes sense for you. Let's talk about a real life story of where alternative lending actually became really economically feasible and really the best option. So this starts from my colleague, Jennifer McLean. She's great. She's out of the Alberta office, and she had talked to a young couple who actually got prime lending for their mortgage, and they're recently married, and they just had a ton of debt they had to pay every month. They had the mortgage, of course, but also they had student lines of credit, student debt. They had credit cards. They had, of course, interest charges. Like they were really getting crushed, and they couldn't like have enough breathing room to buy other real estate or to even have kids or go on vacation. They're really kind of in a hole. So they want to see how can we consolidate some of this debt just to get a bit more breathing room. And that's when they went to Jen, and here's what happened. Now, not to mention, of course, they had a pretty terrible credit score now, a lot lower than before they got their mortgage, of course. So they're in a scenario where what made the most sense was they had equity in their home now because they'd been paying off their mortgage for a little while. And what made sense is actually to use that equity, take out money and pay off the debt, which at of course, lower interest rate than what you're getting with, you know, credit cards and all those sort of things. But the problem was that since their credit score was a lot lower now, when they tried to refinance, when the mortgage was up for renewal, the bank said, no, like we can't do it. So that's when an alternative lender was an extremely good choice just for the short-term solution of pulling out money, forgetting about the credit score being a little bit under, and being able to actually have a plan to just pay less money per month and get back on track to work with an A lender. So is this worth it? As we know, alternative lenders charge a little bit more. So that's 4.7 versus what was 3% with their prime lender. The math there is $350 difference of what they would pay extra with the alternative lender. So they actually did that. And then what happened was that now instead of $3,500 a month, like they paid, I think $80,000 to pay off all their debt, now they're paying $2,100 a month. This includes their mortgage. And now what they came out ahead was, well, the interest they're paying with their credit cards before, that basically made up the $350 a month anyway. So now you're even. Now you're paying, what, $1,400 less than you were before, so you actually have breathing room. And it was only a 1-year term, remember? And now they're paying their debts on time. Guess what happened to their credit score? It went up. So of course they had an exit plan. In a year, they're back to a prime lender because their credit score went up from, let's say, I think it was high 500s to suddenly high 600s, which is a lot because they're of course managing their debt better. And in total, they're actually paying $1,700 a month less than they were a year ago just by strategically using an alternative lender and then having an exit plan and bouncing right back to their prime lender. So where's the couple now? Well, I mean, after they became a lot more debt-free, they have kids, they're traveling all the time, and of course, now they're thinking about their next investment property. The second story here, and it really is symbolic of a lot of stories that we see today, is the scenario where you want to get a house. And the alternative lenders might be able to qualify you. The prime lenders are like, nah, can't right now. Your ratios aren't making sense, debt to income, or you just don't have the right credit score, right? So people will wait 1, 2, 3, 4, 5 years until they qualify for a prime lender, right? And the calculation you got to make here is, well, what's the opportunity cost of you waiting based off appreciation and other circumstances, and you paying rent, of course, versus you going to an alternative lender and seeing if you can qualify now, and of course, have an exit plan. So let's do some math on this scenario, and you're gonna see there's a $100,000 swing potentially if you look at the numbers. So looking at the math, we're gonna look at an example of getting in the market today versus waiting 2 years, right? So if you get in the market today and you can't qualify for a prime lender, you're gonna go with an alternative lender. Let's use the exact same numbers as before, except the mortgage is gonna be $500,000, right? So at $500,000 and you're getting an alternative lender at 4.7%, you're saving about $450. Now, as we said before, you might only need a year of the alternative lender before you level up to a prime lender based off your credit score and your income, but let's be conservative. Let's say it's 2 years, okay? 2 years, 24 months of paying $450 extra than if you would have a prime lender. That equals about $10,800. Now we're gonna assume that you put down 20%, okay? And that, of course, omits you from paying mortgage default insurance. And so if you put down 20% on a $500,000 mortgage, it means that obviously your house was worth about $625,000, okay? Now, let's say that you waited for 2 years. Even with a modest appreciation of 3%, I mean, in the GTA, Toronto and Vancouver, it's in a lot of condos, it's been 4 to 8%, right? Now, from $625,000, it would be worth $663,000, okay? So that's a difference already of about $38,000 just by waiting 2 years. Like, there is an opportunity cost to wait. Not to mention, if you are now paying for a $663,000 home, then you have a bigger deposit you have to pay, and of course, more interest payments on your mortgage. Now, let's not forget, unless you have the luxury or the patience to live with your parents for 2 years, you're probably gonna be paying rent. So call it $2,000 for a 1-bedroom apartment downtown. If you look at that for 2 years, that's already $48,000 of extra money you have to pay by waiting. So let's keep rolling with this example, shall we? Now, you get a place today, you don't wait, and you have a basement or you have even an extra room, you could rent it out. And let's say you get $1,000 by renting it out. In 2 years, that's 24 grand in your pocket by you not waiting and getting into the market now and owning a property, right? So if you think about it, moral of the story, if you can be at peace with paying a little bit more per month of an alternative lender today, in this case $450, you can be $100,000 better off in 2 years. So of course your circumstance might be a little different, but just do the math and the numbers are there, and really think about the different layers of not just hard cost, but opportunity cost, and really you're gonna be a lot better off with your mortgage financing and your personal finance. So what's your next step? Well, do the math, run the numbers either by yourself or with your mortgage broker, and just see what makes sense for you. Now, whether it be you need to consolidate debt and you have to refinance, or of course you have to get into the market today because you don't want to be paying rent or missing out on what of course is appreciation, like the last example. I mean, there's lots of options for you to at least consider looking at alternative lenders, having an exit plan, and honestly being way better off in your finances so that you can level up and do more things in your life. Do you have a question or opinion on this video? If you do, please leave a comment. I love seeing the banter between people, and of course I love responding. And look, if you have a loved one or a friend who is either drowning in debt or they want to get into the market today but they're getting a hard time with their lender, then please send them this video and make sure that after they see all the money you help them save, have them pay for your next vacation. If you learned something new today, or you believe that the savings you'll get with an alternative lender will help elevate your way of life, then please subscribe and make sure you're alerted for the next video. And as always, friends, keep leveling up your living.